Hold on, please. You're live.
Thank you. Good morning, everyone. I would like to call the Finance and Infrastructure Committee meeting to order at this time. And with that, I'd like to ask Rachel to
Morning, Chair Balducci,
here.
Regent Greg Kemp. Absence is noted. Regent Santiago,
Here.
Regent Stewart,
Here.
and I'd like to recognize Madam Chair Ryan and ex officio Professor Blitz. Thank you. We have a quorum.
Thank you very much for that. At this time, I'd like to move adoption of the minutes from our previous meeting of March 15th. I would make that motion. Is there a second?
Second.
Discussion? Hearing none, all those in favor, signify by saying aye.
Aye.
Opposed? The ayes have it. Thank you very much. On today's agenda, we have no voting orders, but we have some very important information concerning dollars and cents, which we are concerned about all the time, which in essence also brings us down to jobs, classes, programs, etc. And with that, I'm going to turn it over to Ben for that and for an introduction also. Ben?
Thank you, Rich. Good morning. Again, I'm sorry to bring you here without action items, but as Rich said, there are some, I think, urgent items going on, which are really very important to CSU, and I wanted to give you an update now with a little bit more opportunity for discussion than at the full board meeting later this month. First, I want to make sure that I see from the minutes that she was at the last meeting, which I hadn't recalled specifically, but my new deputy CFO, Natalie Wagner, joins us here. So I encourage you all to reach out to her if you have any questions, or to me, obviously, but she is a big part of the team and is going to be helping us with some of the tasks that are before us, which we are going to discuss today. So I included two items on the agenda. One is the legislative update, and the second is the preliminary deficit mitigation plan that we released to the public about 10 days ago, or 2 weeks ago. And those two items are sort of overlapping, and so I'm going to start with one and end on the other, if that's all right with you, Chairman Balducci. The legislative session is underway. They are now meeting with sessions in the House and Senate regularly, multiple times a week, and the session is scheduled to end on June 7th, which is Wednesday in 3 weeks from now, I believe. So we are approaching the end of the process, and we are at the time when significant budget decisions are being made and negotiated amongst the multiple interests and parties that exist in the legislature. This year, the governor's budget came out. Obviously, we discussed that it was not sufficient to sustain our current level of operations. We worked very closely with the Appropriations Committee, who's sort of the next touch point in the budget process. They put out a budget that was essentially the same as the governor's proposal, plus it added $82.5 million of carry forward funding. So funding left over from this year that they are able to repurpose and carry forward into the following year. That allows them to work around the spending cap, because those funds have already been appropriated and don't count toward the appropriations cap for next year, as Connecticut law works. So that was favorable. The additional $50 million for 24 and 32 million, I think, for the second year of the biennium were certainly welcome and made things better. However, they did not fully address the current services requirements of CSU, particularly in the second year. As you may recall, the governor's original plan, which the Appropriations Committee built on, included a what did they call it, a glide path, in which they chose to take the level of ARPA funds that we had received in the current year. They reduced that for the first year and then reduced it significantly in the second year, with the implication being that we had sort of 2 years to get used to none of these ARPA funds. And so we should be scaling back our expenditures over this biennium in order to put ourselves in a position where we can function on a going forward basis on the block grants alone. This is challenging for us for a number of reasons. We're working to provide in advance of the budget cycle, which will come in the June cycle of board meetings, some information to try to help all of the board members understand the context of these of the requests and of the appropriation, and some of the things that have gone on. In a general sense, we have seen a significant amount of first federal and then state funds that came in to support us when our operating revenue from tuition and fees had dropped steeply during the pandemic. This all came at the same time that significant additional costs were added as a result of the CBAC agreement, the first year of which was fiscal 22. So there's 22, 23, and 24. There's an option year for 25, the second year of the biennium we're considering now. So we are working with the legislature to try to identify additional resources that we may be able to secure above and beyond the level that was in the appropriations budget. We've identified what we think is the sort of the current services gap between our what the appropriations committee provided us and what we would need in order to operate. I'm not going to say exactly as usual, but to operate without having to undertake program eliminations and staff and faculty layoffs simply to balance our budget. Obviously we are, and President Chang and the leaders of the institutions, I think, are all focused on making our system better, responding to the needs of students today, and making changes to how we operate in order to be more effective. That will continue regardless of the state action, although exactly how it will continue certainly does depend on what the state does. But the level that we identified our deficit is based on sort of a current services level. Doesn't mean that we will operate under that current services construct. We would operate exactly as we do now. We will continue to make changes, but those changes would be driven by student outcomes, student needs, and the needs of the economic needs of the state, rather than based on sort of budgetary exigency and the need to shed expenses quickly in order to live within reduced resources. So just to wrap up the sort of where we are legislatively, we have had a significant, not only did we have a press event a couple of weeks ago, which many of you participated in or were aware of, we also had an advocacy day at the Capitol with, I think, more than 600 students and faculty members and staff in the Capitol, speaking to legislators, speaking to the governor, speaking to staff and legislative and executive branch staff about our needs. I think that was extremely effective and brought home some of the urgency of our predicament to many members of the legislature. In addition, there have been efforts by our bargaining units, I know, as well as campus leadership to encourage folks to reach out to their legislators and to do as much sort of grassroots mobilization around the value of our mission and the needs we have for public subsidy in order to continue to perform that mission at the level we believe is appropriate. So that's been ongoing. I think it has had some positive effect. Certainly our needs are better known by rank and file legislators and by leadership than they had previously been. We have their attention. We have had some conversations with both House and Senate leadership about how we might improve upon the Appropriations Committee budget for us. Those discussions are not resolved by any stretch of the imagination, although we've heard indications of their willingness to pursue some solutions for us. And we're trying to support them in that. I will tell you that there are a bunch of significant issues between the legislative and executive branch that are critical for the outcome for CSCU. In addition, there are a whole series of tax cut proposals, which I am not going to describe for you in detail because I'm not expert enough in them, but they are various income tax reductions scenarios that have been put forward. Those impact the resources available to CSCU indirectly and to some limited degree. However, the constraints that are largely governing the amount of money available for appropriation to us or to any other state activity have to do with the spending cap and what are colloquially and collectively referred to as the guardrails. So these guardrails are a series of sort of good government proposals that were renewed this session after their initial adoption in 2017. And those include a much more strict spending cap than had existed prior to 2017. Is now the constitutional spending cap has been fully implemented after taking a good 27 years to get to that point. So they took steps to fully execute the constitutional spending cap. They added additional rules to that make it more difficult to move revenue off budget or to change the nature of how things are appropriated as one of those sort of structural changes were one of the previous in previous decades were commonplace efforts to manage within the cap. Those are no longer available. Additionally, the guardrails include a limit on how much of anticipated revenue can be appropriated. So they have to leave, I believe, 2% or so of anticipated revenues unspent to sort of build in an automatic surplus. There are also constraints around something called the volatility cap that essentially means that a significant portion of the taxes that are generated from individuals and small businesses through certain, through the finals portion of the income tax, where there's a small business equivalent of that for limited partnerships. Those tax streams, they're only allowed to recognize a sort of historical level of funding from those, and all this surplus goes directly into the rainy day fund or pension payments. So we, those complex of rules prevent the legislature from appropriating more funds to us without engaging in some either trade-offs with other areas of the state budget or agreement with the governor about other alternative approaches. So there are ways in which the legislature can exceed the amount proposed by the governor under the spending cap, but they require consent of all parties, and those are, I think, the subject of ongoing negotiations in the Capitol between the Democrats and the governor. But there are other parties as well. The Republican House Caucus put out a budget recently. I read this morning that the governor was expecting the Senate Republican Caucus to put forward a budget proposal soon as well. So we have multiple budget proposals and multi-party negotiations. I know that several members of the legislature have indicated their desire to pursue a bipartisan budget. this year as they have in the last several years. So clearly it's a complex negotiation with a lot of different values and objectives on the table.
Can I just, but
Yes, of
just
course.
while you're chatting, just to reiterate a couple of things that Ben's saying already. First of all, he talked about talking to leadership. We've talked to Democratic and Republican leadership, which is important, okay? Because you're going to need, hopefully, you probably need both sides on this to get it done. And the key that he had mentioned, the budget cap that was passed in 1991 and then re-strengthened in 2017, makes it really difficult to spend, as Ben's trying to explain, and it's not an easy issue to comprehend. But this whole spending cap, somebody had asked at one point in our meeting, the previous one, well, we've got $3.3 billion in a rainy day fund. The money's there. And you're right. The money is there if you want to take it out. But you can't just take it out because, as Ben has said, there's a spending cap and we're bumping up against that. We're somewhere within $50 million or less of that spending cap. And renegotiating, as he said, is going to be critical. So I would just want to reiterate a couple of things that he has said that I think we'll do also at the meeting next week, that people understand there is money, but you've got a cap. And by the way, the governor is intent on not using any kind of what he calls gimmicks, but what we call adjustments, however you do it, to stay below that cap and yet be able to fulfill our needs for the students, for the faculty, the staff, and the future of the state of Connecticut as far as higher education goes. With that, I'll go back to you, but I just want to reiterate what you said there, Ben. I think it's important.
I appreciate that. So let me talk about the plans that we have in front of us, and I will, in the course of that, discuss sort of what our request has been and give some context to that. And for this purpose, I'm gonna. Do you want to bring up the mitigation plan document, please? So I'm going to show online. This was provided in the package of materials. Go to the first page, please. Maybe you do make that bigger. It's great. No, the table, please. That one. And if you go to the top of it, please. So what we've done, and continue to believe that this was the right approach, although, again, this is all new. This is a very unusual dynamic in the legislature and not one that is anybody has gone through exactly this before. So we're all working to develop effective strategies with imperfect information. But the strategy that we've embarked upon over the last several weeks was that because the Appropriations Committee budget, we believe, was not sufficient to fund our current operations and by a large enough margin that we would have to undertake some significant reductions in what we do. That was based on that conclusion, we developed a sort of tentative mitigation plan. We felt that it was very critical for us to clearly and as dispassionately as we can, considering how I think profoundly all of us care about this, to articulate the shortfall that we foresee and the kinds of steps that we are entertaining and will have to entertain and take in order to address the shortfall that we saw coming out of the Appropriations Committee. So in the couple weeks coming up before the Appropriations Committee, Valentina and her staff worked with the financial leadership of all 6 of our institutions to develop a current and as updated as possible projection of our spending in fiscal 24 and 25 on a current services basis. And our instructions to the campuses and to the institutions was to project spending without doing layoffs, but being, understanding that we're going to be, we're not proposing big expansions or significant growth in our budget in any way, but to continue to meet, to have a staff and faculty of the size that we currently have, and to, implement the kinds of, program changes and things like that that you normally would do, but a no growth current services budget. Based on that budget, we anticipated that, and you can sort of see this top section identifies what that deficit would be. And it shows for 24 and 25 what we anticipate state aid would be under the Appropriations Committee budget, what we think the state aid fringe benefit support would be, what we think our operating revenue will be, that's tuition and fees, and then what we think our expenditures would be, and calculating a deficit. Under this exercise, we believe that the Appropriations Committee budget would leave us with a deficit of about $109 million in 24 and $226 million in fiscal 25. The second year number is a little bit higher than previous, some of the earlier estimates we had, largely because we have built in the assumption that there would be an extension of the CBAC agreement, which provides for 4.5% increases for all of our workforce during fiscal 22, 23, and 24. We don't know yet whether that will be extended, and it would be normally the legislature would not include that. That CBAC agreement accounts for 53.5 million of that 225 deficit. So we think that the deficit, without considering that, would be more like 175 million, 170 million. So that's where we are. Those are very large numbers. I don't know if our dear colleague Sean Bradbury remarked to me at one point that when we think about all of the consternation and conflict that we engendered with the Students First plan, whose original savings target was $25 million, I believe, 23 million, something like that, that the scale of the reductions that would be necessary here at 100 and 175 million dollars dwarf the structural deficit that the Students First plan was designed to address. I just bring that out as a context setting. So we, based on those numbers, we asked each of the individual institutions to develop plans that would address their deficits. Each institution has a deficit that rolls up into these numbers. I will tell you that the deficits are somewhat varied. The financial condition of our institutions is not uniform. The community colleges make up the largest share of that. I mean, they're about almost half of our system in terms of annual spending. It's a big, large system with a dozen community college campuses, and it's obviously a very large institution, and it's appropriate that it would make up the largest share of this deficit. But I'm reaffirming that is true. So the mitigation plan was developed by each of the individual institutions quickly. We didn't have a lot of time to do that, and so it was done by the finance staff with the consultation with their institutional leadership. We don't believe that all the items in those plans are certainly, we don't believe that those are final items. Several of the items we believe were required some refinement and would have to be developed to a greater level of detail to be implemented. The campuses are aware of that and are beginning to look at how to do that in anticipation of potentially having to implement portions of this plan. But we felt that in general, the options that were presented were reasonable for the circumstances and were appropriate in terms of the efforts to preserve the experience for students and to protect students to the greatest extent possible in pulling together these options. Because we frankly don't think it's appropriate for us to identify specific programs or individuals or anything like that at this stage of the game, we chose to roll these options up and we broke them down into several categories, which I'm going to talk about here today. So those categories there were a few revenue options that we identified. The first obviously is tuition increases. The plan for tuition increases, and you can see the numbers there, it's 3.9 million in the first year, 31 million in the second year. The reason it's so much higher in the second year is that our baseline projection already includes a 3% tuition increase at the CSUs. That was enacted by the Board of Regents last year, late in the fall of last year, and that's in place for the fall of 2023. Because of the admission and financial aid and registration cycle at the universities, it would be impractical and extremely adverse to enrollment for us to make a tuition increase, a further tuition increase at the universities now. The colleges, we made a minor adjustment in some fees that were necessary because of some technology changes and the change in accreditation that are ongoing right now. But they're essentially at flat tuition currently compared to last year. Under this plan, they would increase tuition for the fall of 2024 by 5%. And then they would do that again for the fall of 2025. The universities would increase by 5% for the fall of 25. That's why you see a much larger dollar value in the second year. The universities, as you know, have much higher tuition and generate much more operating revenue through tuition and fees than the colleges do. And so a percentage increase has much more attraction. It generates much more revenue at the universities than it does at the colleges. Just for reference, a 1% increase in tuition and fees at the colleges generates about $1 million. Whereas at the universities, it generates 4 million or so, 4 or 5 million. So that's the tuition increase. We consider whether we should ask the universities and the colleges to consider higher tuition increases than 5%. Clearly, there is a need for revenue resources under the deficit mitigation plan. But I think the general consensus was that tuition increases above 5% would be, I don't believe the tuition increases at 5% are well tolerated by our students. I certainly don't think that anybody would think that that was acceptable by any standards. People feel that higher education is too expensive as it is. They're averse to taking on debt. They have financial struggles that are major impediments to their attendance at our institutions. So 5% was seen as the upper limit of what we could do without triggering a substantial decline in revenue as enrollment responds to the change in price. Now, I don't. That is not a scientific effort, and I don't know how we would undertake a scientific evaluation of what would happen at a higher tuition increase, but our logic was that 5% is sort of at the upper limit of the kinds of increases that have occurred in the past, and so would probably not trigger a major change in enrollment. Remember, at the community colleges, a large percentage of our students don't pay tuition. It's covered by the PACT program or Pell. This would still remain under the Pell limit. PACT obviously would cost more, and that might result in us having to turn away students from the PACT program if the state does not appropriate additional resources for it, and tuition rises. There are some other minor enrollment initiatives that are included in the various plans. These were things that the campuses were considering anyways, typically around recruiting stop outs, around there were a couple of where they had new programs that they thought were going to result in increased enrollment. So those the financial impacts of that are rolled up together. The other is mostly interest income, offset by revenue impacts from some of the other options that they had identified. So we lump those up as other. That's why in the second year there's a decline. That's because there was an effort to capture the revenue decline from elimination of certain programs in the second year, offset by interest income. In expenditure options, that's where things get very challenging and difficult. I mean, obviously tuition increases are difficult too. But on the expenditure options, is where most of the savings were achieved in this mitigation plan. The first line, eliminate unfilled vacancies. These are a series, this is probably below the level of a hard hiring freeze. It's extraordinarily difficult for us to undertake a hard hiring freeze, considering the wide array of legal requirements that we have. There are certain positions that, because of compliance or because of student safety or other, highest level concerns that we have, we would need to maintain those positions filled. There also are positions which frankly generate a lot of revenue because they are, a faculty position in a department with growing enrollment, for instance, is worth us maintaining because those certain academic programs generate a surplus of revenue for operating the institution, and we would continue to support those programs under almost any circumstance. So eliminate unfilled vacancies. We believe that could produce about 26 million in the first year and almost 40 million in the second year, just through a whole series of efforts to eliminate full-time vacancies that exist now, and to some limited degree vacancies that might exist in the future. In addition, we have estimated the savings from layoffs of faculty and staff. These layoffs in this line are layoffs to save money. There's no, I mean, they are targeted, targeted based on the financial needs of each individual institution. They recommended, layoffs generally sort of across the board and impacting all areas of operation at each of the institutions. And you can see the savings. The savings are very low in the first year because of the collective bargaining agreements, in many cases require significant amounts of shared governance as we develop specific plans and work with faculty and our other bargaining units to solidify those plans, and then significant notice periods for many of our employees under our collective bargaining agreements. So you see that those savings are slower to materialize because of those constraints. The next line is reduce part-time and adjunct staff. This we're able to do this more quickly by reducing the number of sections. If just as an example, one of the universities this year, in the spring of 2023, undertook an effort to reduce low enrolled course sections for the spring semester. They were able to save, I believe, about $800,000 in one semester through the reduction of the number of adjunct faculty who are hired. I will say that was not without opposition from students and faculty members who felt that those course cancellations were problematic and resulted in limited course selections for some students, created some challenges for individual students to complete degree requirements. I think the university in question was able to find solutions to those programmatic concerns, but still it clearly limits the range of educational opportunities for students at that institution in the year in which we make those reductions. The next line, and now that can be produced relatively quickly, and you can see we think that there is $42 to $46 million of savings each year. That is an aggressive level of reduction of part-time staff, and will significantly impact the offerings across our system. The last one is other reductions. Those were specific programs that were identified by the institutions for reduction. Many of those included some layoffs and personnel reassignments and had personnel impacts, which are captured below. I'll get to that in a minute. But they also had significant other expenses or other financial implications, and were specified programmatic changes. So they include changes to student support services that we offer, that we would discontinue, some academic programs that would be discontinued, and the like. Some of those were quite specific and some of them were less specific, but we thought it was helpful to try to separate those out from the sort of generalized targets for staff and faculty reductions in order to meet financial savings targets. The total of those options is 100 million in the second year, just over 200 million in the, about 100 in the first year and 200 in the second year, leaving small deficits remaining. And then just to complete the description of what's on this page, the bottom section provides estimates of full and part-time faculty, staff, and both unclassified staff. Those are our professional staff at the universities and colleges, and unclassified, and then classified staff, which are folks under statewide bargaining agreements like facility staff, clericals. We have some A&R, which is professional technical careers. There are a variety of folks in those occupations, in those bargaining. And then some management confidential. I don't, this is the outcome of this particular exercise. I think if this plan is necessary for us to implement completely, which I hope it will not be, we obviously would go through a review of all these specific proposals. The parts that are less specific, we would make more specific. We would build in more detailed implementation timelines, et cetera. I think in general, this preliminary plan probably assumes that we would be able to achieve savings more quickly than we actually would be able to. And we would see some of those savings deferred from the first year into the second, and a bunch from the second into a third year. And that we would end up drawing down on reserves, probably in excess of the $7 and $20 million that are shown here, as we work through implementing what are unquestionably extraordinarily challenging budget options. So I'm gonna I think I would probably open it up to questions about the budget mitigation plan. And then once that's done, I wouldn't mind talking a little bit about some of the other materials that I provided to you, but I know Professor Blitz has his hand up, and others of you may have questions about the deficit mitigation plan, which I'm happy to take.
I'll defer to the voting members of the committee if they have questions before me. I have a number.
I have a couple of questions. We spoke CBAC contract, Ben. It's about $180 million. Am I in the ballpark with that over and you said 51 and 25, I think. Where's the rest of that money tucked away? 24 and 23, correct?
Well, the CBAC agreement adds about $30 million of PS of salary costs each year, and that compounds. So 30,
right.
60, 90. In addition, there's a fringe benefit component to that, which is complicated to figure out, but on average, our fringe benefit rate is about 70%.
Right.
So I believe that adds another $20 million a year, again, compounded as we go through to our costs. So yes, by the third year of the agreement, we think that the total cost of the CPAC agreement, third year being fiscal 24, is about $150 million for the system. Now, the state in its block grant increased CPAC only by the portion that is in the general fund. So they've picked up about $14 million of that each year, leaving the remaining operating fund, the other half of our of the raises, to be paid for by student tuition. In other years, that's been possible. That the student tuition goes up by a few percentage points in order to cover the costs of those tuition supported faculty and staff members. Because of the decline in enrollments coming out of the pandemic, that is the only way to recover enough additional revenue to make up for those operating fund employee costs would be to raise tuition at levels that are adverse to our enrollment and adverse to our affordability.
But one of the things, and to lead into that kind of a comment, it was my understanding, just correct me because I once was wrong. The legislature and the governor supported the CBAC contract, but I thought it was understood that we would, as in the past, gotten support for the fringe benefits and the wage increases. And that doesn't seem to show up anywhere in this proposed budget, Ben, and maybe you could just help me out anyway.
I'd be happy to. And I'm going to turn, if you look on the couple pages back, there's a table that's called state appropriations. It shows a series of those. If you look at and I'll just pick the state university line, which is the third line down. And you can see that the current year's funding for the block grant at the Connecticut State University is $175 million. Well, that's a little misleading because that includes a whole bunch of retro payments for the prior year. But you can see that it's gone from 161 to 174, and then from 161 to 174. So that $13 million over 2 years is OPM's calculation of what the general fund portion of those raises was during that time. I believe that they may have underestimated the portion that is covered by the general fund some by a few $1 million, although that's hardly my most significant concern with the budget. But more to the point, they've completely walked away from supporting the operating fund expenses for personnel, which the state had been supporting very heavily in recent years. If you look in the column for fiscal 23, for instance, you can see that below the block grants, there are all these other one-time sources of funding. There's an additional $64.5 million in fringe benefit support, $118 million of ARPA funds to support our operations. There were, obviously money to pay for an extra payroll 1 year. There was deficiency funding for wages. So they had previously been supporting our growing operating fund expenses with what are now being referred to as one-time appropriations. So we have received a fairly heavy amount of one-time funds in fiscal 22 and 23 from the state for recurring faculty and staff salaries and fringe benefits, and those go away. So while the state has made some increases in its block grant to reflect growing salary costs, they have essentially, at least under the governor's proposal, and to a somewhat lesser degree under the appropriations proposal, walked away from the support that they were offering to alleviate the burden on tuition of paying for all of our non-operating, our operating employees.
Even if they just took care of the benefit side package, that 65 million, that would make a big impact what we face as we go forward, Ben, instead of looking at 235 million, now you're looking at, 160 million, and some of the bad things or negative things we may have to do, we'd be able to eliminate at least the worst of the worst.
No, there's no question that there are, I mean, it's a, there are any number of things you could point to that if they were different, we'd be better off. And that certainly is among them. I will say, though, that I remain deeply frustrated that we have not been, that we do not appear as though while we may be successful in getting some more money than the Appropriations Committee has proposed, and we're working very hard to see that that happens. It is likely to come as a restoration of some of these one-time funds that we have been able to take advantage of. Those one-time funds are helpful and they allow us to continue our programs. And as I've said many times, one-time money is better than no-time money. However, we have recurring expenses. We are operating institutions that exist over many years, and we are paying faculty and staff on under labor agreements that assume continued employment for those individuals. And frankly, we run programs that assume we will continue to have faculty and staff to serve students going forward. Funding those with one-time funds, which are repeatedly on the block for ending, puts us in a position of lurching from one year like this to another, and we would love to see a more stable and predictable source of funding for the system as a whole that did not presume steep tuition increases every year simply to pay for collective bargaining agreements and growing fringe benefits costs.
Any other questions by any of the committee members?
Yeah, thanks. I have a couple of questions. First of all, not that I in any way agree with the Secretary of the OPM, but certainly in all of his statements, he refers back to an exaggerated ask in CSU 2030. And my question is, because what seems to me is that the OPM, which has played obviously a significant role in the governor's budget, is reacting in a certain sense to the 2030 request. And then we're falling far short just of operating expenses as a result of their underfunding of the system. So my first question is, what role did the FY24 and 25 CSU 2030 request play in this whole process? Because those requests were to double the funding from FY23.
This entailed moving a lot of the one-time funds that we have been receiving into block grant. So we did propose that not only we asked for funding that we thought would support our operations, plus support an agenda of change and expansion, although mostly change. There were a few targeted areas where we identified things we wanted to do in addition, but most of the funding in the CSU 2030 plan was simply to meet our ongoing obligations. We certainly talked about additional vision for ways in which we would like to see the system change and grow, but fundamentally the numbers were driven by a projection of our financial need that we put together in the fall of 2022. We actually now have more current information and are basing our revised requests to them and our negotiations with them currently based on our most current projections of what our spending would be. The question of whether the boldness or the scale of the request for 2030 was tactically effective or not is one that I will defer to others who are perhaps more removed from the situation or who are wiser than I am. I know that there was significant support from our faculty and from our staff, and I believe from the board for President Chang and the system to make a bold request for transformational budgeting, basically giving us a long-term commitment to a level of funding that we think would support positive transformations within the system and growing operations and serving more students. That we made that request, and currently their funding is well short of that. But I don't know whether that request was useful part of this process or not. It's probably too soon to draw any conclusions.
Thanks. I think that's a from your point of view, a very clear statement. I read through very carefully the pamphlet, which is the only information that I had on CSU 2030, and I suspect that's all the information many others had. And it would really have been helpful had that brochure or that pamphlet or that explanation delineated the difference between the transfer of one-time payments into the block grants and also those funds for change and expansion with further details of what that involved. That said, my second question is, to what extent is the shortfall, let us say for FY24, attributable to the community college sector, and to what extent to the university sector?
It is of the deficit is attributable in the first year is attributable to the community colleges. However, the universities, that share goes way down in the second year. The universities are extraordinarily challenged in the second year of the biennium, based on their faculty costs and staff costs. Obviously,
excuse me, Ben, can you repeat the beginning of your answer to the to Professor Blitz's question? The audio on YouTube cut out there.
I didn't plan that. I'll mumble through there. Yes. No, in general, in the first year, the problem is about 3/4 at the community colleges, and about 1/4 at the universities and Charter Oak. And that becomes more, the shortfall is more evenly distributed in the second year, largely because the universities are far more dependent on full-time faculty and staff, and their ability to address, they have more flexibility within the university context, as I'm sure many of you know, to adjust their spending in the short run, because they, somewhat less of their budget is driven by personnel costs. However, by the end of this of the 2-year period, all of the institutions have significant deficits which jeopardize their operations.
One more question, and that is the question of, well, I agree with you, by the way, that the problem in FY25 is much bigger. Now, it seems to me there must be also midterm adjustments to these budgets that are made. Is that correct? Would there be some corrections that would be possible, not in the FY24 budget, but in the calculations for FY25 in FY24?
Well, there's certainly, the legislature does meet every year, and they often adopt midterm budget adjustments. They did not adopt midterm budget adjustments, I don't believe, last biennium. So the recent pattern is not to adjust the budget. And frankly, even in recent years, often those adjustments have been somewhat minimal. I also, I don't mean to sound negative, but there are a great number of analysts who have some apprehension about the direction of economic circumstances. that there is, there's a fight in Washington right now about the validity of American debt, of sovereign debt of the United States. There is the prospect of, the high unemployment, the high employment levels and high inflation levels, and the action by the Federal Reserve to address that through interest rate hikes. All of those indicate a slowing of the national economy. So there are a lot of reasons to think that the legislature might either not adjust the budget in the midterm, or that their flexibility to adjust the midterm would be impacted by tax revenues and economic circumstances. So I don't think it's wise for us to make assumptions about the second year, particularly given that at the scale of the reductions that would be necessary to address, this budget as described now, would require us to lay off employees. And laying off employees requires a long period of planning and notice to be effective. So if there is a major structural deficit in the second year of the biennium, it is my professional advice that the board should immediately undertake staffing reductions to address the budget in the second year because of the long period of time it will take to realize savings from those actions, that there will be a significant use of reserves during that time period, and that those levels of reserves would not support operations for 3 or 4 years if we were to wait and determine the outcome of yet another legislative session before taking action.
But on the worst case scenario you just sketched, that would in fact be a rainy day.
In my opinion, however, we do not have a rainy day fund as such.
Okay, my last question, you mentioned reserves, and that is, what role do the reserves play? Because I notice in the statement again from the OPM, and it's not because I'm in any way in agreement with that body, but the fact is that that seems to have just played a role in their argument for the level of funding, the inadequate level of funding they have proposed, and that is that the CSU reserves have increased from 162 million in 2013 to 308 million in 2022. What percentage of those reserves are encumbered and cannot be used in to fund operating expenses, and to what extent are they being planned to be used, let us say, for FY25?
The level of income, they're not encumbered. There are two ways in which the net position and these surplus resources of the system are identified. Some of them have been, and these are terms of art under GAAP accounting. There are reserves, fund balance that has been designated by the board for certain activities. And that number is relatively small. There are, in addition to those are, referred to as restricted funds. So in the case of, typically they're restricted by an outside entity. So if somebody gives money to an institution and says this can only be used to pay for one thing or another, then those are considered restricted. And there's a legal obligation for us to maintain those reserves for that restricted purpose. That's a relatively small share. We're going through now, I've asked my staff to go through and review all of the restrictions and designations of fund balance across all of our institutions to be sure that we have a clear understanding of any legal restrictions that we have and accurately reflect those. In addition, some of the universities have made a practice of designating reserves for specific purposes. One of the largest of these is for debt service. So they have debt service for their auxiliary programs, and many of the campuses have established designated fund balance that they hold aside for the purpose of paying future debt service in the event that they're unable to pay that through their normal budget process. Those are designations by management which are not necessarily, the management designated them that way, and management can undesignate them and make those available for purposes. And by management, I mean the Board of Regents. So in many cases, those designations are simply expressions of our intentions at the time that we made those designations, but those can be reconsidered. We are going, as I said, reviewing all the specific, and there are hundreds of designations of fund balance across our institutions, which need to be reviewed. We are doing that, and we'll be able to make recommendations for precisely what share of the $300 million in current estimated reserves we have are in fact available for us to balance the budget. There are other factors at play as well. We need to consider the cash within the operating fund and the impact of some of our financing activities on those reserves. We're in the process of reviewing that so that we can provide, in the context of budget implementation, a very clear understanding of what resources are available to the system and how to use those. The way that reserves are used, there are kind of two ways that I see reserves can be used to address this problem. One way is that the board could identify specific reserves, and we've segregated those reserves by institution and by system, to identify those reserves and make an explicit transfer of some of those funds for a particular purpose. So you could say we are, using $10 million of our reserves to support the budget that we're enacting for the universities. That the board has that authority to do. They have broad authority over all the reserves of the system to use for the purposes of the system. So that is one option. The other option is that if we were to put forward a budget plan that included savings based on a whole series of complex actions that we were intending to take, for instance, eliminating academic programs, the reserves would serve as in the event that the savings we were able to achieve during that time period fell short of our target, then the reserves would be effectively reduced by that amount when the audited financial statements are reviewed. So they would look at if we'd intended to save $50 million with X, Y, and Z activities, but we only saved $20 million, that $30 million deficit at the end of the year would show up as a reduction in our net position, which would in turn reduce our reserves by that amount. So it serves as a mechanism by which our bills would be paid at the end of the year if we are unable to live within the spending plan approved by the board, or the spending plan can intentionally include use of reserves as part of that plan. Since I suspect that under almost any circumstances, this is going to be an issue we will have to address, I am certainly willing to consider and welcome all of the board's views on whether or not we should be prospectively identifying reserves to support programs, or whether we should simply allow them to be a backstop in the event that we are unsuccessful in closing the deficit through implementation of policy. I will tell you that I am extraordinarily, while some of the communications about our reserves have indicated that somehow it was, accumulating reserves has been creates this opportunity for us to be short funded. I don't believe that is the case. Our reserves at $300 million reflect barely 25% of our annual operating spending, which I think is, given the economic uncertainty and the social uncertainty in this world around higher education and the pandemic and the economy, is very appropriate for us to have reserves at that level. We have worked very hard and have been focused on building our reserves and have managed our federal grant funds and have managed our operations with an eye toward maximizing our reserves because of our awareness of the uncertainties that we face. I am much more comfortable going into this with $300 million in reserves than 200, and our ability to have built up that additional $100 million in reserves over the last several years is, I think, one of the bright spots in the current conundrum we face.
Not talking about reserves for the individual institutions.
No, the $300 billion number that Professor Blitz identified, which I agree with, that's projected, that's through 22. Those figures are, those include reserves of individual institutions as well as system reserves, both in the community colleges and the universities.
And some of the universities have little or no reserves, and a couple of them have pretty decent reserves. And to me, anyway, as far as the university and colleges go, I personally don't think it's right to take somebody who's operated well and saved their bucks, as opposed to somebody who has not managed well and don't have any dollars in reserve, to take those from the good and give to the bad, punish somebody for doing what they should have been doing in the first place. From the college and university standpoint, that is just.
Well, I certainly understand that view, and I know that many of the folks at institutions, particularly those with stronger reserves, feel the same way. It would clearly require the Board of Regents to direct reserves from the system office to Central Connecticut or from Eastern to the community college. The board could do those things under the authorizing statute, but has not in the past. And I think those would be significant steps that would only be, I can't imagine the board considering those unless there were very few choices. The system reserves are significant. Of the 300 million, I think 100 million of that or so is in system reserves, which would allow for the system to address shortfalls at an individual institution without directly utilizing reserves of another institution. In addition, to the extent that we have one-time funds as part of our budget, and in the Appropriations Committee budget, there's about $150 million of one-time funds. In the second year, it's about 75 million. Those funds, at least as they were provided to us in recent years and as they were proposed in the governor's budget and the appropriations budget, were not specified for any particular component of our system. And so the use of those one-time funds at different institutions is a question for the board, and that we will be making recommendations about that as part of our spending plan recommendation to you in June, and that it would be my hope that we find a balance between ensuring that institutions are fairly funded from that CSCU-wide pot of one-time funds. So there's, on the one hand, making sure that every student is receiving appropriate funding based on the number of students at their institution. And then on the other hand, addressing areas of weakness and shoring up institutions that have more acute financial problems. Those are competing interests, and I think we will undoubtedly make a recommendation to you that attempts to balance those appropriately, and we will be very clear with you about the extent to which we have done exactly how we have proposed to balance those two competing interests.
Thank you, Ben. Any other comments by members of the committee? Yes, Madam Chair.
Yes, thank you. Ben, this is directed to you, and it's far, far out. What relationship do the different universities and or college and or community colleges have with their foundations? I really am not that familiar. I just know that I don't know if all of them have a foundation and they raise money toward, I don't know if it's toward scholarships. I believe it's toward scholarships, but I mean, it's far out, but is there anything there that can aid in this dilemma?
Yeah, we have foundations. Each of our institutions has a foundation. There's also a system foundation, which is mostly sort of transactional. Although I believe it also holds the Marco Jakian Scholarship. They have various missions and organizational documentation, but their general mission is to support students through
Right.
scholarships. That is their primary mission. There have been some instances in which the foundations have provided operating support to institutions. That was going on at Western for quite a while. And I don't believe it's continuing now. That creates sort of a problem. I mean, I suppose, again, when you use one-time sources of funding or time-limited sources of funding, when they end, you're left finding and making difficult choices. Their organizational documents generally require them to support students through scholarship funds and student support programs and efforts. So I think that for their endowments to be used to balance our budget would be not appropriate and not be the appropriate use of those funds. There are sort of on the margin, I would say that there are staffing arrangements. So there are statutes that govern, and we have organizational documents that govern our provision of staff, because raising money for scholarships is a fundamental purpose of the institutions. And so we sometimes have staff who work alongside the staff of the foundations. Some of the college foundations are very small and are essentially unstaffed, except by institutional advancement staff at those colleges. So there may be some way in which the foundations can cover more of their expenses and thereby relieve that from tuition and fees and move those over to the foundations. However, the foundations are, with some exceptions, not in a particularly good financial place to support large, new operating expenses, even of their own fundraising operations. So while the foundations may ultimately be involved in some of the organizational changes that would be required to meet this budget, I don't believe that they are a significant part of a financial solution for the budget. I know Natalie's been working on some of the foundation work. I haven't misstated there.
No, that's right. I mean, I think to the extent that we would be looking to them to cover costs of the institutional staff, for instance, that are supporting their work, we would probably, in most instances, find ourselves, looking at the fact that her staff have been playing that role because the foundations could not do it for themselves. So I think that that's right.
Yeah, we take money out of students'
Right.
pockets. And so it would be tantamount to a tuition increase in that respect.
Thank you.
Any other questions? Is there any other business to come before the committee? Or entertain a motion to close this or move to close the committee meeting? I just like to thank Ben for a very nice job in the explanation of the major problem we have before us. You do pretty well, my friend, handling the problems without.
These have not yet been, I can describe them today. I am not quite sure yet how we're going to solve them or manage them, but we are working very hard on those measures as we speak.
And I think it's been good that the unions, faculty and staff and the board have worked together, which is something that's quite unusual over the years in the past. So for that, I would say thank you very much. And thanks to all those folks out there, faculty, staff, unions, and members of the board. With that, I would entertain a motion to adjourn the meeting. Is there a second?
Second.
All those in favor, signify by saying aye.
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 Thank you very much. Have a good day, everyone. Thank you for being here.
Thank you.
Thanks, Ben. Good job.
Your live stream is stopped.